What's up guys, Richard K from Price Action Income, and welcome back to another YouTube video. In today's video I want to be talking about fibs or Fibonacci ratios. The most common ones they use is obviously your retracements and also your extensions. But for me, it's just a small part of my tool set that I use. Fibonacci ratios, I like to use them in combination with market geometry. And especially when I see a confluence of these ratios with market geometry lines is where I would typically take trades from. So I know a lot of traders use fibs. They are very important to use. Millions of traders that look at these levels either during retracements or extensions. But I kind of find them very useful when I apply them over my corrections, which is the main thing I'm trying to do in my analysis, is try to track a correction within a trend and try to figure out where that correction might end. And then using additional tools apart from my pitchforks, like channels, for example, and then also fibs to basically figure out where all these things cross, if you can say that. So just a quick example here on crude oil. Very, very nice example. Obviously, we know that crude oil went to zero or below zero last year, April. Price moved strongly to the upside. Now, what fib traders or guys that use fibs in their analysis would quite often do is obviously wait for a retracement. Let's say price went up, and then wait for a retracement, and then look at these important levels like your 0.382, 0.5, 0.618 or 0.786% retracements for support to come in, and then price hopefully then resumes a trend. But in many cases, when you're dealing with very strong trending type of markets, it can be often quite difficult. Let's say you use this low in the first major correction that happened in crude oil that ended last year, November. I mean, price didn't even reach the 0.382% retracement. So that's why it's also quite important to adjust your fib levels as price moves higher. But in a lot of cases, when you do have a runaway market, whether it be bearish or bullish, then quite often you won't see that price actually retraces back to a fib retracement level. That being said, I'm just going to show you some examples of how I use fib extensions quite often with my corrections, and I think this is a really, really nice example. As you know, you probably know that I follow quite a few different corrective patterns. My first one that I always have in the back of my mind when I believe a correction is happening is a single zigzag, which is in this case is an A and a B and a C as they call it, or a single zigzag. Now there's combinations of this. If this pattern, let's say I were to enter here, it goes up, it fails, goes up and moves down again. My second go-to pattern would be a double zigzag. So I'm going to show you this because it's one of the most common patterns that is around and some of the techniques that I apply. Now, obviously, you probably know by now, if you're new to this, then you would not know, but I use pitchforks, and where this correction started from, moving down to the downside, first anchor point, second anchor point, and then price fails to move to the upside, okay? And that will be my third anchor point. And in this case is what I'll be looking out for, is price returning to either the lower median line, or extreme cases, your lower red warning line. And this is a shift pitchfork. Again, my go-to pitchfork setting that I use with corrections, because corrections are quite often flatter in angle than a trend would be, for example. And that's why they become very, very useful to use. In any case, that's how I would create my how can I say, my support and resistance or buy and sell zones that I identify beforehand. Okay, any case, but this is just part of the analysis, and this is where I like using fib extensions. Very often, if you're dealing with a single zigzag, you'll quite often find that your first drop will obviously be a certain range, and if you project that first drop from where your lower high in this case ends and price broke this low, you'll find that if you use fib extensions, let me just do that your first drop lower in this bearish scenario will quite often be similar in length or distance than, or your second drop, sorry, would be similar in length or distance than your first drop. So you can see price failed to break through the 100%. It also failed to break through the lower median line. And this is quite often what I'll do. I want to see a confluence of multiple drawing tools, in this case, fib extensions at an important level. I know that ABCs are symmetrical quite often in nature. Then also I use channels. Channels the same as a modified pitchfork if you use the same anchor points. And, you know, I get a question a lot as to which settings should I be using. And if you are using both, in this case, the channel in combination with the shift, then draw an area where they basically, or the buy box in this, or buy zone in my case, sorry, covers both of these lines. In this case, we also had another confirmation, 100% extension. So this was just an ABC, beautiful ABC. What else I would like to show you today, which is really cool, they quite often, these ABCs like to have symmetry in time as well, if I can show you that. And what I just want to do is quickly use my time measurement tool. Very often you'll measure your first drop to that low over there. That was 9 bars or 13 days. And if you project that over your second drop low, in this case a C wave, then price 100% also done in exact same time and in same range and meeting these median lines. There was multiple confirmations of different analysis techniques pointing that this could be a strong low. But obviously you don't just trade your forecast. It's great to draw these boxes, but we need confirmation and confirmation entry conditions, as I call them, like reversal candlestick patterns, momentum divergence, which are things I covered in previous videos. So just one technique that I use on the fib extensions, in combination with my market geometry. Quite often you can see in a market like crude oil, for example, that in some cases it will extend to 1.382 or 1.618. Any deeper than that, and then I will start questioning whether I'm dealing with a correction or not, because it's the other leg's not as symmetrical in range as the first one. Quite often that will point, if it did drop quite lower, that we might have a more of a complex correction if you're still of the opinion that market's going to go up. All right, so another quick example I want to show you on the AUD USD. Let me just zoom out here quick. This is a standard pitchfork that I've had on my chart since last year, September. Or sorry, this year. I drew this. I felt that this was the operating angle that these median lines were drawn at, that contained the price of this market extremely well. And this is one of the methods that I'll use. I have a longer term pitchfork sloping in the same direction. Again here, if you were to use a fib retracement to, let's say, that first little correction, it didn't even reach the 0.382. You know, so there are some cases where you can move it up from the previous move up, and there we have a confluence of the 0.618 with a centimeter line where price moved down to. But let's quickly forget about that. I want to use the fib extensions over this again. I know what the trend is. The trend is up, and if I assume that this is a correction, in this case we had an A, B, C. You wouldn't have known that this was going to happen afterwards. But if you were to draw a little pitchfork there, look where price basically, again on the shift pitchfork, price touch this upper median line of this upward sloping and this lower median line of the corrective pitchfork that I use quite often. And price moved up. Now, even if you got in here using proper money management, you shouldn't take a loss if it reversed lower. And like I said before, this is the most common corrective pattern in ABC. Now, if it fails to break this high and moves low again at this stage, you should immediately start thinking, okay, hang on, we're probably dealing with a double zigzag. So always think you're using or you might be seeing a single zigzag, and then it might morph into a double zigzag. Quite often, if you start seeing triangular patterns move sideways, like symmetrical or ascending or even expanding triangles, they're a little bit more easier to identify just because of their shape. But when it comes to zigzags, always think single zigzag, or that's what I think at least. And then if I fail to trade the first zigzag, then think about that it might morph into a double zigzag. In this case, I quite often teach you'll have an ABC and what they'll call a WXY. So this is one zigzag followed by an axis with another zigzag. Now see, it's quite difficult to figure out where this ABC is, which is another reason why I use my Pitchforks so often. Let me just get my magnet mode on there again. So you have an ABC, fails to move new high. So that's the lowest low in this sequence. That's the lowest high over there. And here we have a great example again of where price actually reached the center median line. You want to trade this because I would like to see it reach either your lower red warning lines or your lower median lines in combination with a different sloping angled pitchfork, if that makes sense. So there we have another entry box, or a buy zone as I call it, where price basically touched where they both crossed and moved to the upside again. But since we are talking about Fib extensions or Fibonacci ratios as well, also very cool, we had that drop lower, and if you go up from there, it reached the 1.382. So there was a confluence of strong median lines, in this case the low red warning line, this one that's sloping upwards, that defined the long-term trend, and the 1.382. And that is how I would like to use my Fib extensions or some of these ratios in most of the cases. I think even here we have that same thing where we go from that high to this low. First ABC took 8 bars or 12 days. And if you project that to the start of this lower high to that exact low here, again 8 bars or 12 days. So you have repetitive time cycles as well, if that's what you want to call it, or just it took the same time for the first ABC to take place and the second ABC to complete. And that's just an additional technique that I use. They work fantastically well on single zigzags, and in some cases your double zigzags. It's just a really good example of how you have time repeating, you had multiple angles of pitchfork sloping in different directions, and then also the Fib extension that I overlaid over there, all telling me that there's a lot of support that could possibly come in that area. And then, like I mentioned before, we're going to wait for reversal candlestick patterns, momentum divergence, and then that would tell you to get in. If you don't see those patterns and stuff, then I'll stay on the sideline. All right, guys. Anyway, hopefully you enjoyed that. If there's any questions you might have, or have any markets you want me to have a look at, or show me some more of these examples, then please drop a comment down in the comment below this video. If you've done so before, then please hit the subscribe button, notification bell, and be notified next time when I release another video. Anyway, guys, until next time, have a good one. Bye-bye.